So welcome to this webinar. I hope you've read through the risk warning at this stage. Let's move swiftly on from there. So the webinar today being how Forex trading works. The Forex market's the biggest market in the world and operates 24 hours a day. However, there are a few little nuances like trading in pairs and the use of trading on margin or leverage that make it a little bit different to some other markets, namely the stock market. So this webinar covers some of those first steps in understanding the Forex market. I would actually go probably beyond that and say this is not just going to be a 5-minute video on the basics of Forex. It's going to really kind of take you right through exactly what this is all about. As I said, without getting to the stage of actually telling you what news and chart ideas that you can follow to actually bet on the direction, it's just all the information that you need up front to decide if trading Forex is for you. So some of the topics here, what are the major currencies that are available to trade, some of the characteristics of the market, advantages and disadvantages of Forex, all important question, how do you actually win or lose money from this, how Forex quotes work, which obviously I mentioned they trade in pairs, so that's a little bit different. The Forex contracts, tend to trade large amounts of Forex at a time, so just explaining all that. And then how much does it cost, obviously an important question. And then we'll go through an example on LCG's trading platform, which is called the LCG Trader. So these are the major currencies, number one on the list being the US dollar. So all these major currencies you can see listed here on the side, they all basically have a 3-letter shortened version of their name, which are used in the currency quotes. So obviously you can see the US dollar and the British pound. And then you can see this is a grab taken from the LCG Trader platform. I'll show you that later in the presentation, as I mentioned. But here you can see GBP USD. So that's the exchange rate of obviously the pound against the dollar. But you can see that in the platform we trade minor, Australasian, Scandinavian, exotic currencies as well. So a lot of different Forex pairs on offer. So some of those minor, as they're described, currencies you might want to consider, for example, the Swedish krona, or exotic might be the Mexican peso. So some of the characteristics of the market that make it a little bit different from others, like maybe the stock and bond market or commodities, something else you're used to, is that it does in fact trade 24 hours a day, and that's just not our pricing of it. The actual underlying market, the spot Forex market, does trade 24 hours a day across the 3 major global regions of Asia, Europe, and the US. The Americas, I should say. That's 5 days a week, so it's close to the weekend. So you do get some time off from it. Daily volumes eclipse that of global stock markets and even the bond market as well, which is a lot bigger than the stock market. So why does that matter? Well, it makes it very liquid. Now that's sort of techie term, if you like, but basically there's just a lot more trading that's taking place. And so why that's good is that you don't get stuck into a kind of situation you might face if you're trading penny stocks, for example, where you buy the stock, but then when you want to get out, maybe you've made enough profit, or maybe the market's dropping and you don't want it anymore. Sometimes there's just literally no one to sell it to. It's very rarely the case in the Forex market, because there are so many buyers and sellers, and the net result being that the seller who's willing to sell at the lowest price and the buyer who's willing to buy at the highest price meet very close in the middle, and that means the spread and other costs of trading are relatively pretty low in Forex compared to other markets. It's very fast moving, so it's typically the fastest to react to global events. So, you know, for example, Donald Trump reimposing new sanctions on Iran. You know, you typically see the reaction in 24-hour Forex markets before you see it happening elsewhere. It does trade in pairs, so that takes on a little bit of initial extra understanding, but the advantage of it is that buying and selling is just as easy, because buying GBP USD means you're buying the pound. Selling GBP USD means you're buying the dollar. So I'll explain a bit more about that in a minute, but it just means that you can basically trade rising and falling markets, which is a distinct benefit because it covers all market conditions. And it typically involves trading a margin. Now why? Basically because the price moves are small on a percentage basis. So there's a lot of movement in the day, but actually in terms of the total price of the currency, they don't move that much. So you need to trade a large amount to make it worthwhile. So while that's all well and good for people with hundreds of thousands of dollars to throw around, what makes this market interesting and over the last decade or so has made it accessible to your typical individual trader with a bit less money than that to trade, is that you can lose the margin and still trade those big contracts. So just to go over some similar points again to what we were just saying, but some of the advantages of Forex is you can trade those rising and falling markets. So if you think the market's going up, then you go long. If you think it will fall, you go short. The cost of doing both is just the same. Now, it trades 24 hours, and this is nice so that it doesn't confine you to working hours. So if you're still working full-time, obviously you can find a time to trade that suits your schedule. Use leverage. So again, that's another word for margin. And it allows you to place bigger trades using less capital. And so when we're talking about advantages here, that helps reduce the barrier to entry to newer traders, as I mentioned before. You can trade on multiple markets. So while we're talking about Forex today, the advantage of opening an account with LCG and trading through it is that you can trade shares and stock indices and commodities and ETFs and various other multiple markets all together with Forex. Now, just a couple of disadvantages to mention about Forex, and this list is by no means exhaustive, but it's what comes to mind to me, is that actually the use of leverage amplifies losses as well as potential profits. So obviously if you're placing a large trade with a smaller amount of money in your account, then it can, that as a percentage of your account, those losses will be exaggerated. And so it can actually result in a situation where the losses exceed your initial deposit. Now, LCG does have various protections in place to try and avoid that happening, so it's rare, but you've got to be aware it's possible. You've got to be aware of the risks. And no ownership. So obviously when you're buying shares and you get a certificate in the post, that doesn't always happen these days, is in theory you can go along to the shareholder meeting and maybe even have some influence on the company. Obviously that doesn't happen when you're buying currencies. Really the only buyers and sellers that have a major influence on a currency are central banks. But as I mentioned in brackets here, ownership rights, not typically an issue for individual traders, more of an issue for institutions who actually could weigh in on a decision the company's making because of the size of because of the number of shares they hold, the percentage of the market cap that they hold of the company. They have some strong voice. As I said, not typically an issue for smaller traders. So that the all-important question, how do you win or lose when you're trading Forex? There's basically two factors. A, you want the market to move in your favor. So if you're buying pounds, you obviously want the value of the pound to rise. If you're selling the pound, you want the value of the pound to drop. And then just how far it moves. So this is not just a one-way bet. It's, you can be a little bit right or you can be very right. You can be a little bit wrong, you can be very wrong, depending on how far you let the market move for and against you. But obviously the overall aim is to pick the right direction and ride that price move for as long as you can. And you can do that all via an online trading platform, either on your computer or your phone, and it's all very easy to do. And we'll give an example of it at the end of the presentation. So Forex trading is a form of derivative trading, which is a bit of a kind of scary word, but actually it's very simple in this case. It's just that the price you're trading is derived from an underlying market. So you're not trading on an actual market, you're trading on the prices from a market. So in the case of Forex, the underlying market is the OTC or over-the-counter spot Forex market. That's interesting just because it's not an exchange. So it's not like you're trading on the London Stock Exchange or the New York Stock Exchange. The over-the-counter market are deals agreed between the top major international banks amongst themselves, and you then get, because there are various deals taking place within those, between those big players, there's no one centralized price. Now LCG gets its prices from those large institutions and then makes a market by giving you, the client, a buy and a sell price. Now, as you can imagine, it's a very competitive marketplace. LCG is not the only one doing this, so the net result is that the prices that you get are pretty similar across the marketplace, just because obviously if they weren't, you know, a client would be able to buy with one and or buy in one place and sell in another. So net result being the buy and sell price generally pretty similar, but you've got to be aware that it is LCG making those prices. It's not, you know, you're not buying on the exchange itself or in the over-the-counter market itself. If you want to do that, you basically need to be Goldman Sachs, or you need to be some, you know, Ray Dalio's hedge fund. It's the huge players that play directly in the Forex market. Everyone else goes through an intermediary. So when you buy, you buy using the ask price, and when you sell, you sell using the bid price. I'm going to elaborate on that a little bit in a minute. That all relates to the spread, which is the main cost of trading Forex. And just a bit of lingo here is that when you're going long, you're buying the market. When you're going short, you're selling the market. So as I mentioned, the Forex is traded in pairs. So the exchange rate for the British pound against the US dollar would be an example. So just if you're a British traveller travelling to the States, obviously you've got pounds, and you maybe want to use dollars while you're in the States. Well, how much is your £1 going to get you in dollars, right? So that's what the exchange rate is obviously telling you. How much is a pound worth in dollars? So in this case, it's written GBP USD, as we kind of mentioned at the start of the presentation. So if £1 is in fact worth $1.50, GBP USD would be quoted as 1.5000, and there's typically 4 decimal places there. There can be 5 or 6, but that's really just a almost unnecessary level of detail. So an FX pair consists of a base and a variable, or sometimes called counter currency. So obviously that's the GBP, and then the slash, it's the slash is dividing the base and the variable. Now there's various conventions that I won't go into here because there's no real need about which currency goes first. Oftentimes it's the US dollar that actually goes first, but there are certain currencies that supersede the dollar, so the pound being one and the euro being another. So you normally see euro dollar, pound dollar, but you see dollar yen. So there are historical conventions for why, historical reasonings for why all that happens. It's pretty irrelevant though, to be honest. The base currency is the first named currency, and it always equals 1. So in this case, obviously, £1 equals $1.50. The second named currency is the variable, and it's called variable, and it is variable. That's the amount that moves and determines the tick value, or in case of currencies, ticks are often called pips. So for GBP USD, GBP is the base, USD is the variable. if GBP moves by just a very small amount, 1.5000 to 1.5001, then it has moved by this small increment, obviously, the fourth decimal place, $1. So obviously $1 being up here before the decimal place, $0.0001. So that's why you can imagine, obviously, if you're buying $10 worth of pounds, you know, you're not going to make a whole lot from that tiny price move, right? But obviously, if you're buying millions, you suddenly are making thousands instead of fractions of a cent. So that's where these larger contracts come into play. And as I mentioned here, that small number of dollars is referred to as pip. But the key thing here being that number there is dollars, right? So it's how much has £1 changed in its dollar value. So that's the key to remember. And as we said up here, it's the second currency, in this case the dollar, that determines the tick value. Any questions, of course, please fire them through to the questions box, and I'm happy to elaborate either at the time if I see it or towards the end of the presentation. So just moving swiftly on to the spread. There are two rates. So it makes sense, right? Even when you go into the foreign exchange office, if you're not actually trading, you're just exchanging money. There's the rate that you can buy pounds at with dollars. That's called the offer rate, as we mentioned before. And there's the rate that you can sell pounds at to get dollars. That's the bid rate. So so when we mentioned before GBP USD might be quoted as 1.500, it's actually never quoted as just one price. It's always quoted as two prices. So again, that's the price you can buy at and the price you can sell at. How to remember which is which? It's quite easy, really. You always get the worst rate. If you think about this, it's the bank, it is basically the banks ultimately that are providing this pricing. And obviously they're providing it, the whole basis for them offering it in the first place is that they make that difference in between. So they make the price that you would want to buy at higher, because obviously you want to buy at the lowest possible price, so you don't get the high price. You don't get the low price, you get the high price. And if you're looking to sell, obviously you want to sell for the highest price possible. But the bank wants to sell it to you for the lowest price possible, so you get the lowest price. So just an example here being, if the difference between, in this case, is about 2 pips, which is something you will see as fairly typical for a spread, then 1.5002 minus 1.5000 equals 0.002, and that is a 2 pip spread. Now there's more to get familiar with when you start trading yen and cross currency pairs, where you trade pairs which don't involve the US dollar. But luckily, all those kinds of calculations are made automatically within the trading platform. So you just need a bit of a general idea what you can expect to earn from the trades you're placing in terms of the value of each pip. It won't always be exactly equal to $1. Obviously, if you've got pounds in your account, you're not necessarily interested in how much a pip is worth in dollars. You're more interested in what it's worth in pounds. So you just have to get a feeling for the exchange rates involved to actually get a feeling for each point the market moves, how much is it going to be worth to me. In terms of the contracts that you trade, I've mentioned a couple of times now that you tend to trade larger amounts of currency than you would shares, for example. So one standard contract is in fact 100,000 of the first currency denominated in the second currency. And likewise, as you can see on the screen here, mini and micro are just divided by 10 each time. So a mini contract is 10,000 of that first currency. So in the example that we've been using throughout here, it'd obviously be £10,000 would be worth X amount of dollars. So in the example, the quote that we've been using, which is actually, doesn't match current prices, but is actually historically about right, £10,000 would equal $15,000, right? 10 times 1.5 basically gets you your $15,000. And again, micro is a much smaller one, down at 1,000. So the size of the contract, why is it important? Well, like when you're doing any kind of trading, obviously if you buy more shares, if the price goes up, it's cost you more up front, but you're going to make more, right? Because you've got more shares to take advantage of it. Just the same in currencies. The more currency you've bought, the more you're going to benefit when the price goes up, the more you're going to lose when the price goes down. Now it also affects the spread, because for the same reason, you're just going to pay proportionately more spread than you would on a bigger contract than you would with a smaller contract. Not in any unfair way. It's just directly proportional to the size that you're buying. So we'll go into a bit more detail on that. We'll show it in the trading platform a bit later. And obviously, if that's not clear, again, just shoot a question through. And then the last thing is that there's the cost of overnight financing. And I'll explain a bit more about that in a minute. So again, more of the kind of same info here about when we're talking about how much it costs. There's spreads, there's rollover, which is that overnight financing, but there's never any commissions in trading Forex, which is nice. The overall cost of your trade depends on the spread, the position size, as we've been talking about, and how long you leave the trade, because that affects how many nights worth of rollover you're going to be paying. And again, I'll explain that. I'll show you in the platform where you can see what that rollover cost is. So this is a little visual that you can see on the screen here. The spreads will vary according to how busy the market is, in effect. So typically during Asian trading, there's not as much trading that takes place as there does during London hours. So you might see slightly higher spreads then. Only slightly, I would say, through LCG. Another example is if there is a news event about to happen in a few minutes' time, often the amount of trading volume will stop because people are waiting for that data to come out. So then, because there's less trading taking place, like we explained at the start, that spread will widen out because again, the seller who's willing to sell at the lowest price and the buyer who's willing to buy at the highest price, they will not meet as closely in the middle if there's less traders out there. And typically there are more popular markets than others. When it comes to Forex, easily the most active pair is euro-dollar, and then it's these various other major currency pairs that fall in behind that. Dollar-yen is number 2. Cable, or the pound against the dollar, as we've been using as an example in this presentation, typically comes in at number 3, and then you've got the Swiss franc and all those others that I mentioned on that first page. The spreads will vary slightly within those pairs based on the overall volume of trading that takes place in those markets. If you're interested, follow this link here, go to the LCG website, and that shows you all very transparent how much all the spread costs are that you can expect to pay through LCG. So elaborating on this idea again with the position size. So when I say position size, I just mean basically how much of the currency you bought or sold. So have you bought 10 mini contracts? Oh, sorry. Have you bought 5 mini contracts? That'd be 5 times 10,000, so a 50,000 unit of currency contract. Or have you bought 3 standard lots? So that'd be 3 times 100,000. So a very simple example being that if the spread is 1 point, before we use an example where the spread was 2 pips, say it's 1 for ease of calculation. If you hold a position size where the value of each point is worth £1, then obviously your spread will just be 1 times £1, which is £1. But if you're trading so that the value of each pip is £100, well then suddenly the spread will be £100, not 1. Obviously it's all completely proportional. But you just got to be aware, obviously, you're going to benefit when the price moves in your favor, if the price moves in your favor. But it's, you're going to pay for that extra benefit via the spread. Rollover interest being the last thing here. Sometimes it's called swap or financing or funding, are all different words used for this. But rollover interest is charged for holding a trade overnight. So the way LCG does it, and the way most brokers do it, is once it goes past 10 p.m. in London, which obviously normally matches 5 p.m. in New York. So basically, if you think about the trading day, kind of starts in Asia, ends in the Americas. So the end of the US trading day is 5 p.m. That's when you consider it the end of the day and the new day starts. Obviously, you've got to set a time somewhere, because as we mentioned, it's 24-hour markets. So that time set is kind of in alignment with US stock markets. And now in Forex, it's worth noting that the rollover can be both earned as well as paid. So it's not always a cost to you when it comes to Forex trading. Just as a quick one on this, without going into too much detail, it's quite elaborate, and to be honest, LCG don't even do this ourselves. We are given a rollover cost from the banks. Quite where it comes from is a bit esoteric. It's based on overnight financing rates, LIBOR and all sorts, risk factors in the market, etc., etc. But it's basically the idea of it is that typically these financial contracts, they close at the end of the day. So we talked about this over-the-counter market. These over-the-counter deals that are taking place typically last one day. So in order to roll over that deal to the next day, you just have to account for the interest that would have been earned on that money. And that interest rate is determined by all these different things I'm talking about, which is a bit random. But the ultimate idea of it is that, say, for example, at the moment, in the US, interest rates are higher than in Europe. Then in that case, you should earn money when you're buying the dollar, and you should pay money when you're buying the euro, because you earn money by earning the higher interest rate, by buying the higher interest rate pair currency, and you pay money if you're buying that lower interest rate currency. So I think it's about time we place an example trade in the platform. So I'm going to place a trade, try and change the position, calculate spread, rollover, how to work out profit potential, how to limit loss, potential loss, and entering a long or a short position, which we now know is a buy and sell position. If you haven't already done so, obviously to kind of follow along with this, you'd need a demo or live trading account. You can find those at this address here. Right. So here's the LCG Trader platform. So I've got it set up with a view which I think is somewhat close to the default view, where you've got to this watch list on the left-hand side. If you are missing that, this is the way you can change the layouts over here. This little icon, click on that, you can see the watch lists have disappeared, and now they're back again. And you can see there's various markets available to trade via LCG, but if we find Forex, here it is, and you can see there's the major pairs listed there. Various interpretations, obviously, because you've got the major currency, but then what do you determine to be a major pair? So, we've put euro, yen in there, for example. It's not necessarily a major pair, but it involves two major currencies, and it is a very popular one to trade, like was pound yen. Some people classify some of the, like the Australian dollar as against the US dollar as being a major pair. Likewise, the New Zealand dollar against the US dollar, some people classify that as a major, some don't. The classification's pretty incidental, really, but it does make it easier because there are so many pairs to trade, just to kind of split it up into some sort of category. So let me switch gears here to a a demo trading account where we can actually place a trade. So obviously you can see at the top there, as I showed you there, is that you can actually place, you can have multiple accounts all accessible very easily from the trading platform. So you can even have accounts denominated in different currencies, or some, if you're in the UK, you can have spread betting and a CFD, etc., etc. Or maybe you've just got different trading strategies for different accounts. Again, you can have multiple accounts easily accessible from the platform. So I'm going to go for probably one of the major pairs. We've been using pound against the dollar the whole time, so probably best not to switch from that. So if you want to buy pounds, literally there is a buy button flashing at you. You would just click on that, and you can see up here order filled at 135.94. And you can see down here in this tab we've got a list of positions. Ooh, I've got a Facebook trade making $55. So here is our pound trade that we've just placed. Now what you'll see is that I placed a quite a relatively small size trade there for £1,000, so that's basically a micro contract, if you like. And the trade is immediately in the negative. Why is it immediately in the negative? Am I just very unlucky? No, it's just that's the spread. That's how the spread is accounted for right at the start of the trade. You pay that spread up front, and then once you've moved, once the kind of gross balance here has moved in positive territory, you've obviously paid off your spread, and the rest of the money is yours. No extra costs to worry about, not when you're exiting the trade or anything. The money that you see there, that's yours. Now, what else did I mention I was going to look at here? Obviously, I could place a sell trade. So if I click the button there, you can see that I've now got a separate sell position. So actually, I've inadvertently hedged myself here, where I'm buying the pound in one position and I'm selling the pound in another position. So likewise, you can kind of see that the two are related here. The buy position for the pound is not really working out in my favor. Let me drop down to a smaller time frame chart so we can see what's actually happening here. You can see that the market is dropping, so this little red candle here is pointing down. So hence my buy trade not working out so well at the moment, but my sell trade starting to move towards positive territory. We'll have to see what happens there. You can see the overall trend of the market on a very short time frame here has been up. So let's see if that buy trade can win out eventually. Now, let's see, what else was I going to look at? Changing the size of position. Okay, let's do that. So at the moment, you can see that the size of the trade is 1,000 British pounds. Interesting little button here, double position. This is 2 hours pointing up. Click on that little bad boy. You can see that we're now buying £2,000 worth. Let's equal it up by doubling up our sell position. They're still pointing up, they're not pointing down, even though you're trying to make the market go down. It's just obviously 2 hours to indicate that you're doubling the size of your trade. Interestingly, this little button here got obviously a kind of about turn looking angle to this arrow, and it's basically saying that you just switch around your buy to a sell. So, you know, say for example we initially placed that buy trade, didn't we? And we thought, actually no, you know, the last few candles seem to have been down, so actually maybe I'm going in the wrong direction here. Let me just change this up around, and suddenly your trade is going in the other direction. So that's a convenient feature to have. Otherwise, what you can do is you can right click here and you can click modify position, or you can go over here and you can click this little kind of cog looking icon and you can modify position there. So what we can see is that our current position is 2,000. Say we want to go a bit more all out on this. We want to buy £100,000 worth. We can just change it right there. This is the desired position. So we only had 2, but we want 100 now. So we're basically, by doing this, we're adding 98, right? So that's why this button says we're adding £98,000 worth to our position. So boom, we've done that. Let's just do a little refresher of that situation. Let's do the same with our sell trade. Change the desired position from 2,000 to 100,000. You can say to do that, we need to sell an extra 98,000. We'll just click that button there. Boom. So I think it was actually saying when we placed that trade, it wasn't really necessarily saying it, but you can sort of see via the amount that's moving up and down in dollars here is that instead of with say 2,000, every time there was a little points move, it was affecting us by about 10 cents. Now it's affecting us by more like $10. So, or 20 cents, now it's more like $10. So you can see there kind of the spread that we've paid and we're trying to get over is proportionately more, but obviously we're going to be making more per pip now. Let's have a little look at the info of our position that we've got so far. You can see we've got an open position, buying one lot, one standard lot, obviously, 100,000. But we don't have any stop loss or take positions in place. You can see this is a kind of net amount that we have open on the trade. So one thing we can you kind of want to do here is what I've done is I've just jumped straight into the market. Obviously I've bought and sold at both at the same time, which is fairly pointless. Obviously you're just going to be locked into paying that spread. You want to be exposed one way or the other in the market to either win or lose, hence, or otherwise there's no point. So what you want to do is kind of ideally set a price where you're going to limit your losses and set a price where you're going to target some profits. So I would suggest logically the market kind of gravitates to where it's been recently. Now this is a fairly basic bit of analysis I'm doing here, so don't put too much stock in this. But you can see that the market has recently been up here. So our buy trade, we might want to target up there near 136. The market's also been down here recently, down near 35.70, call it. 135.70, 136. So those might be areas we want to target either side of the price. So what you can then do, if you want to modify your position here, let's modify our buy position. Now we're going to say we want to take profit up near 136. Now we can see straight away that would lock us in for $164 in profit, and that's about 18 pips away from where we currently stand. Now we also want to limit our losses if it goes the wrong way. Now there are different ways of doing this. You can set a stop loss which is a smaller distance from your take profit area. So that would make it more likely to be hit, but obviously you're winning more in a winning scenario than you're losing in a losing scenario if you do it that way around. Obviously you can put your stop loss further away than the take profit order. That would make your take profit more likely to be hit, right, just because it's closer by its very nature. But obviously when you win, you're going to be winning less than when you lose, you're going to be losing more. And there's every different way in between. So say we wanted to just put our stop loss down near the bottom here, down near our that place that we'd put down there, 35.7. You can see that we'd make about 164. We'd lose 136 if it went the wrong way. and then just click this protect button. And you can see that now there's a little line that showed up on the chart. In fact, it's very difficult for me to move my my green line. Oh, we can see the market's budging up to the top side now. You know, I mentioned the overall trend was higher. But anyway, we can't read too much into this quite a small space of time in which we've had the trade open, but the buy side of the market is now winning out for the time being. If we did decide that we didn't want our sell order anymore, what we could do is we could just get rid of it straight away from the chart here. Or maybe we didn't want our take profit anymore. We could, our stop loss. We could just get rid of our stop loss down here. Remember that you can see right here on the chart, they're risking 136 to make 164. We could just say, okay, no, we don't want to risk that anymore. We're just going to leave it open. Or we maybe want to let the trade run further. We can just get rid of that profit target up there. But at the moment, what's good about this is that we've got our orders locked in place, at least on our buy order we have. And so then we could just walk away from the platform and it wouldn't matter. Those orders are still in place. Now let's just look at the spread and the rollover, work out those costs. We've already talked about the potential profit and loss here and entering a long and short position. So let's just see how we can do that. Best way for me is if we are back over here to the kind of dealing panel, if you like, or the watch list area, is you click on this I for information, and you can see right down here that this is your funding cost. So if you are, as we mentioned before, the interest rates in the US currently are higher than they are in the UK. The pound is obviously the currency of the UK, dollar is the currency of the US. So you make money by holding trades overnight which are selling pounds and buying dollars in effect, and vice versa. For if you're buying pounds, you're going to be paying overnight. If you're selling dollars, same thing. And then this little information panel here basically gives you most of the information that you need to know. Obviously, you can see most of the market hours are 24 hours, as we discussed. If you are placing a trade right at midnight, right at 10 p.m. UK, you might notice it's a little bit difficult to place a trade then, because there is a sort of 3-minute gap, I would say, as you can see in these market hours, where these rollover costs and things are kind of applied to accounts, and it means trading can't take place. And then the kind of this is all just the kind of detail in which the price can be traded. So you can see, actually, as I mentioned, it does go to a 5th decimal place, but that pip that we've still been talking about all along is the 4th decimal place. So obviously that 5th decimal place is a 1/10 of a pip. And this is just the leverage available down here. As you can see, the bigger the trade you place, naturally it takes more for LCG to hedge that. So the less leverage is available. Was that all I was going to? And then the spread, probably something I should have covered straight up front, as you can see, is basically the difference between this buy and sell price, and you can actually see it right here. It's this, you can see it's variable based on how much volume is going on, but it kind of fluctuates in this instance somewhere from sort of down 0.8 up to sort of 1.3. It's somewhere in that vicinity. So I think that's probably that's all we need to cover for today. I hope that was useful information. Went on a little bit longer than perhaps we anticipated, but that's actually part of the course these days. It seems to happen every time. I hope that was useful, everyone. Thank you very much for attending the webinar, and please follow LCG and myself on Twitter and other social media channels, and obviously get those accounts going if you haven't already, in order to practice some of these ideas. Thanks a lot, everyone. Jasper signing out.